Investor's Guide. Thank you so much for tuning in. On this show, we'll help you organize all of your money, and you'll realize when your money is organized, there's so much more of it than you had initially thought. Grab a pen and paper, write down all of the advice you hear on the show, pass it on to friends and family who you think could use some good personal finance advice. Dhirendra Kumar, the CEO of Value Research, joins me on the show. It's always a pleasure to have Dhirendra.
Thank you.
Let's take a look at what we're going to be doing today. We'll take a look first at our conservative portfolio and tell you what returns you can expect over the long term. Our conservative portfolio is designed for someone who's approaching retirement. Also, the portfolio of the viewer we are looking at is also approaching retirement. So this is a special episode for anybody who is in the 50 age group or above and you want to get your money organized before retirement. This is a good episode to watch. In our product review, we take a look at UTI Opportunities. We look at all of the performance and tell you whether it makes sense to hold on to it or not. And also, is this the right time to invest in debt funds? That's coming up later on the show. Dhirendra, thank you so much for joining us. Our conservative portfolio is the one we're looking at today. It's going to come up on the screen. There it is. Our conservative portfolio has a couple of funds in it. The idea with this portfolio is to keep your money safe just before you retire. But if let's assume retirement is not the goal I'm saving for. If I'm saving to buy a home, and we have a lot of people who are doing that, so you have to put together this massive down payment of 20 lakhs, sometimes 30, 40 lakh rupees. And I know that I'm going to buy the house in the next 3 years or the next 2 years. Can I use portfolio to keep my money safe? Does it apply in that case as well?
Yeah, it definitely applies in that case as well. And also buying a house is not a very, is a little bit of negotiable goal in the sense that you don't have to buy. It's not like child's education or, daughter's wedding where you on a specific date you need all the money or a reasonable part of the money or a well-defined part of your accumulation. So, you're working towards this, and this is also an accumulative portfolio. You are not drawing income from this. So in that sense, yes, it works well.
So here's what we're talking about. Remember now, when you're going to buy a house, you're sort of breaking various investments and accumulating money for that big purchase. You'll take some money out of mutual funds. You'll borrow some money from friends and family. You put together that down payment. When you get it ready, that's when you're looking to buy the house. And there are a couple of months before you actually get the down payment and when you actually buy and part with it and cut the checks and, do all of the work. Where does the money sit in the meantime? It should not be in your bank account because that's far too less, 4% that you'll make, a maximum of 6% in some accounts. That's not enough. The fixed deposit might be able to give you a little more, but then again, because you're looking at a liquid stage, you don't really know when you want to take that money out and you'll lose some of that money on a fixed deposit. The other option is to use a debt fund. But Dhirendra is saying that this is the best option, given the fact that you don't know when you might need to take the money out. Here are the funds in this portfolio. The FT India Dynamic PE Ratio Fund of Funds, the HDFC MIP Long Term, the Reliance MIP. Now, we hypothetically invested 10,000 rupees in this portfolio every month for 7 years, and the total value of this portfolio is currently 12.50 lakh rupees. Now, it's a total gain of 10.73%. Compare that to what your fixed deposit has given you or what your bank account has given you, and you'll see the difference. Dhirendra, obviously, anybody who's using this portfolio is not going to use it for a period of 7 years or 8 years, because if that's your time horizon, you should ideally be invested in equity. Over a shorter period of time, if I'm only going to use it for 2 years, will it still give me the same 10%? Is that a fair sort of assumption to make?
Yes, it can be a bit lower if you're grossly unlucky, but at the same time, it has much lower downside compared to a balanced portfolio. We have to really understand that what it is. It's 35% equity and you're accumulating in it. You're accumulating your savings. So you're averaging your investments even in equity and only to the extent of 35%. Think of it as a reverse of the stable growth portfolio, which is dominantly fixed equity, as marginally fixed income, and it provides you far greater stability than equity. In this case, you are reducing your allocation to equity substantially, that the downside. So the worst case scenario will be the returns will match that of deposit, and the bright side could be that you will have 1.5 times, 2 times more than what you will earn on a deposit. So the worst side is guarded, and that is the idea.
The worst side is guarded, and of course I'm going to give you a recap of the funds in this portfolio in case you want to go ahead and invest in these funds. The FT India Dynamic PE Ratio Fund. the HDFC MIP Long Term and the Reliance MIP. Just 3 funds. The idea is to keep your money safe as you approach your goal, whether that's retirement or buying a house or your child's education. This is where your money moves so that it doesn't see any sort of massive choppiness from the market. So if the market cuts very badly, you don't lose a lot of money. That's on your screen right now. Write to us if you have questions about that fund. Moving on to our special segment, when we take a look at your financial plan. Our profile today is an army officer, Dhirendra, nearly retired, 55 years old. He has a pension already looked after. All of his goals are achieved. He has nothing to worry about. He's looking forward to a happy retirement. He wants to know how he can get his money organized. His primary responsibilities, he says, are over, and he'd like to right now put his money in a sort of an easy-to-manage sort of way. So the good thing about the armed forces is that the insurance is taken care of. You don't have to worry about health insurance, and you don't have to worry about the pension. He has the IPRU Life Stage Pension Policy. He invested 6 lakh rupees. It now stands at 10.3 lakh rupees. And he has 10 lakh rupees in shares and 5 lakh rupees in mutual funds and about 20 lakh rupees in fixed deposits. How should he organize this money better, Dhirendra, to be better prepared for his retirement, which will happen in about 5 or 6 years?
Looking at his goals, his basic income in retirement is taken care of. At the same time, he's 55-year-old, so, he should have a sizable, given that he has enough resources, he should have a sizable emergency fund or, ad hoc expense money. So he should have a deposit. He should have, or a deposit or a fixed income fund, fixed income investment, which is meaningful. But the money for the long run, the money which he would like to leave or, which should optimize, the money which he's unlikely to need for times to come, that money should get organized in a very methodical way. And there are 2-3 ways of approaching it. And he has actually attempted all parts, all kind of it. He has shares and quite a sizable, investment in shares directly. He has the mid-cap funds, and then he has the balanced funds, and he has, on the other extreme, he has this ICICI Life Stage Pension Plan. He didn't require that, so he should look at it only from an investment perspective. So it is an unwise thing. He should withdraw that money. Then comes which of these 3 approaches. He has mid-cap funds, he has balanced fund, and he has shares. All the 3 ways are, valid ways, the right ways, to approach his for his long-term investment. If he's investing in shares with full understanding, I would say that once he has taken care of his emergency needs and other things, he should be an all-equity portfolio. If he's doing it just randomly and if he has just accumulated a portfolio of stocks without much of an understanding, then he liquidated that and diversified through a mutual fund. With mutual fund, he has 2-3 ways of approaching it. Even some of our portfolios will help him do that. But even in his holdings, he has these 2-3 things. One is keeping it simple, balanced fund. It will be tax efficient. He'll be able to grow his money. He'll be able to grow it with great simplicity without any downside. So if he's an investor who gets upset with any big decline in value of his investment, he should approach that way, conservatively. And at the same time, it will be tax efficient. If he's fine with it and he thinks that he should not have the shares, then he should approach it, with a multi-cap fund, the Prima Plus and, ICICI Value Discovery. He should have only those kind of funds. So these are 2 approaches which he should follow. And he should choose just one. Just having pie in all of them will not help.
This portfolio can be simplified greatly. Dhirendra there telling you what you should be doing. Dhirendra, let's take a look at the funds in his portfolio specifically. He's also written to us saying that he's happy with his stocks portfolio. He doesn't want to touch it right now. So he can move the money out of that ULIP that he has and possibly repurpose it in his mutual fund portfolio. He has the HDFC Mid-Cap, Prudence, IPRU Balanced, Mirae India Asset Opportunities, BNP Paribas Mid-Cap Growth, Franklin India Prima Plus, Dividend and Kotak 50. These are all good funds. He's obviously picked them over a period of time. My question to you is, does it make sense altogether? Individually, they may be great funds, but as a portfolio, are they sort of cancelling each other out, or do you think it makes a cohesive portfolio?
I would say that, he can well have just 3 funds. 3 balanced fund, or, the 3 multi-cap fund, ICICI, the ICICI Value Discovery, the Prima Plus, and one more fund like that, a Mirae Asset, India Opportunity, and that will be a good portfolio. That will be a complete portfolio. it will be manageable. He will have a sizable interest in that. He will have exposure to mid caps as well as large caps. And he's unlikely to be disappointed in bad times.
This is the advice that you're getting right now. If you don't want to touch your shares, that's fine. But take a look at them and make sure that they're working for you. Keep pruning that share portfolio. Make sure you have the right shares in your portfolio. Dhirendra advising you to move your money out of the ICICI Prudential ULIP and dedicate that money more to your mutual funds. And he says it doesn't make sense. You just prune your mutual fund portfolio as well. Keep only the multi-cap funds. Make sure that you invest in sort of a regular manner, in a disciplined, long-term manner. Only your long-term money should find its way into equity mutual funds. The rest of it seems to be fine the way it is right now in your emergency fund and the rest of your investments. So your key takeaway is to organize the money that you don't need for the short term and simplify your portfolio. All right, let's take a look at UTI Opportunities this week. We've got a few emails from viewers asking us, since the performance is slipping, whether we should hold on to this fund or is it time to exit the fund. Avan is here to give us those latest numbers of that performance. Avan.
Thanks, Faye. This week, we take a look at the UTI Opportunities Fund. With just over 4,799 crores as assets under management, this fund was launched in the year 2015. While the fund has outperformed its category and benchmark over the long term, its short-term performance is not very impressive. Let's take a closer look at the performance chart over the last 5 years. You see that the red line, which is the fund, and the blue line is the benchmark. Now, the fund's performance has been average since the year 2010, just about beating its benchmark and the category. The fund was the worst performer in the year 2015 with a return of -6%. The fund beat its benchmark and category marginally over the long term. You'll see that the fund's performance has been average when compared to its peers. Also note that over the last 1 year, the fund's performance has dropped drastically when compared to its peers to just 3%. So do you hold or sell this fund? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for those details. Dhirendra, UTI Opportunities, we've gotten a couple of emails from worried viewers who say the performance is slipping and they're not really sure what to do about this fund. It's down to 3 stars on value research. Would you recommend investors hold on to it?
No, it is proving to be quite an average fund of late. And, marginal underperformance to its benchmark in near 3.5 of the 5 years, recent 5 years, is quite disappointing. And, this fund has done very well, did very well 4 or 5 years back, and after that it has struggled. Has also seen quite a few fund manager change, and it has also changed. It was also always large cap dominated, and UTI Opportunity. The strategy is to capitalize on dynamically on some situation by focusing on some sector or some special opportunity, and it has done nothing of that sort of late. Frequent manager change is also disappointing. So yes, I don't see a reason why one should continue with this fund.
Dhirendra, I have a question to ask you about the entire UTI equity pack right now. They seem to all be middling, the charts. We don't see any of those funds rising to the top, and that's been the case for a couple of years. Have they lost their edge? The funds that we used to talk about a lot on this show, funds like UTI Dividend Yield, funds like UTI Equity, this one, the mid-cap fund, does it still make sense for us to hold on? Has the fund house sort of lost its fire?
So I would say that yes, I find that many of the funds are unable to even make a comeback now. I also find a lack of a concerted effort in terms of driving the portfolio differently. UTI Dividend Yield Fund is an exception. All others, yes, they are middling.
There are all other funds other than UTI Dividend Yield. For those of us watching at home right now, should we be taking a look at our portfolios one more time to see if we have a UTI fund and then make a decision on whether or not we should hold on to them?
Absolutely. Many funds require revisiting the rationale why you should be there. And 2 years back, they made a comeback. They were fairly impressive, and they were the focus. I don't find that very sharply, visible now.
All right. And finally, Dhirendra, the fund that we are talking about right now, UTI Opportunities, would recommend investors exit. And how many stars would you give it on Investors Guide?
On the performance, it's an average fund. It's not a great underperformer, and it has not been an outlier on the performance side. But that it has flexible mandate. It was supposed, opportunity, given the flexibility, it is what was expected. It has not the expectations. So, and a superior alternatives available in the large cap universe. So, UTI opportunity should not be part of one's portfolio.
All right, so sell UTI opportunities there, and an average fund would be about 3 stars on Investors Guide. Dhirendra, before I let you go, a quick question coming in from 45-year-old Rajdeep Singh. He plans to invest 3 to 4 lakh rupees in debt funds over the period of 3 to 4 years. He's only been using fixed deposits so far, and he wants to know if it's the right time to begin investing in debt funds. Given where we are in the interest rate cycle, Dhirendra, there are a lot of analysts who are expecting interest rates to come down over the next year or 2 years. Is it a good time to invest in debt funds?
Yes, but primary guidance for investing in debt fund should be not that whether it is a good time to invest in debt fund, but whether you can afford, if you can't invest in equity, then your money should be invested in debt fund. Now, depending on the cycle, market cycle, you can't really make a choice. If you want to optimize your return on fixed income, which is, and the fixed income money allocation should be generally the money with which you are unlikely to take great risks, which you don't, a part of your money which you don't want to see decline in value on most occasions. That money should be invested in fixed income, irrespective of the interest rate cycle we are at. And then, depending on your time frame, you should choose which kind. There are funds where you never lose money, and there are funds where you can optimize your return, and I think it is a good time. Maybe, we have seen this big fight between, the talked about thing is Raghuram Rajan and the government having a different stance on the outlook for the interest rate or outlook for inflation. But yes, despite that, we have seen rate cuts. And one fund so far, trading 1 year, 3 year return is double-digit return, which is quite impressive. And I feel that, that returns will come down, but they will still be fairly impressive, and they'll be far higher than the available deposit or the risk-free return available to Indian investors. So one should invest in fixed income fund. One should, and if you're investing with 2-3 years time frame, I would say that one can also take a chance, without assuming great risk, with MIP kind of fund which will have 10-15% allocation to equity. If you are investing accumulating, then a different thing. As a lump sum investment, that's a fund where you don't take a big risk with catching a market high.
We hope that advice has helped, and I want to take you through the key takeaways of this segment. Remember, it's not enough, like Dhirendra said, to pick a lot of good funds. They have to make sense together as a team. So you can't just pick randomly because they're good funds, good performers. They won't make sense together. It's important that altogether your portfolio does make sense and it works together. They complement each other. Also, like Dhirendra said, money saved on tax is money earned. So keep a very close eye on all the tax saving and make sure you're taking advantage of all of your tax saving options available to you. And finally, choose your investments not based on whether or not it's a good time to invest in something, but who you are as an investor. So what is your risk appetite? What is your time horizon? How much time do you have? If you only have 6 months or a year, then by all means use debt funds. But if you have more time on your hands, more than 5 years, then you should be using an equity fund. Dhirendra, thank you so much for spending time with us this week and answering all of our questions here on Investors Guide. This week we have Karthik Zaveri, who's joined us to answer a couple of questions on asset allocation. First question comes in from Chetan. Chetan says his family income is about 19 lakh rupees. He bought 2 flats, which paying EMI of 40,000 rupees right now. He also has an LIC policy and a PPF, and he pays close to 1 lakh rupees on tax. He wants to know how he can reduce that tax. It's very important, Chetan, to bring down your tax as far as possible. Every rupee you save on tax is important. Karthik, what advice would you give him?
So we need to understand here, what is the status of these 2 flats? Have you already got possession of these flats, or are these under construction? So prima facie, if these are flats which are under construction, then you're not going to get any tax benefit out of it. Also understand that from an income tax perspective, there is only a certain amount to the extent that you can get tax benefits. You can't really go beyond your section 80C and the deduction that you get on interest. So therefore, now in your case, if out of your properties, if one of the properties is your own investment, then which is your self-occupied property, then in that case you will get deduction up to the extent of 1.5 lakhs on principal repayment under section 80C, and you will get about 2 lakhs from your section 24, which is basically the deduction that you get on interest repayment. Now, if the situation is that if you are going to have this property which is a let out property or a deemed let out property, then in that case the entire interest can be offset against the other heads of income, and thereby you will be able to save a little more tax. But other than that, you know, you're already doing your PPF, you're already doing your LIC, which is all going to fall under the same 80C. So there is only that much that we can do under Section 80C. We can't really go beyond it.
64-year-old Mukul Bhattacharya has written in as well. He's going to retire soon. He's been investing all of his money in superannuation and bank fixed deposits since 2013. He says one of his deposits will mature soon and he'll have 15 lakh rupees. With the declining rates of interest of fixed deposits, should he be investing in a systematic withdrawal plan instead? I don't know if the systematic withdrawal plan actually suits your needs. I'm going to consider him more a candidate for a balanced fund. What would you recommend he does, Karthik?
So you see, Mukul, and for all the other viewers who are in a similar situation like Mukul, this is typically what happens in case of, and what we in financial technical language call the reinvestment risk. So when you get into a fixed deposit, you have a certain rate of return that you're going to enjoy for a certain number of years. Once that period gets over, then you have to renew a fixed deposit, and chances are, and they will always be the case, that the renewal rate will be much lower, because as a country, as we keep progressing, the rate of interest that you'll earn in your deposits will keep falling. So therefore, what's your next best option? So the suggestion here is to go into an instrument which is not only tax efficient but also gives you a better rate of return, and which is exactly what you're looking for. So therefore, think about going into bond funds, and within bond funds also think about going into what is known as the liquid funds and the ultra short term bond funds. So there are 2-3 things that play in your favor here. One, it is extremely safe because your portfolio is still corporate deposits and bank deposits, pretty much what you're already doing. Second is that there is hardly any risk. I mean, there's practically no risk in terms of capital loss in such a situation. Third, you will get a little better rate than what your fixed deposits are giving. Now, here you need to take an educated guess. Unlike a bank fixed deposit, you don't have a certificate which says that you will get XYZ sort of rate of return. So therefore, you need to estimate that, you know, your rate of return would be approximately in the range of about 8%, 8.5%. And then according to that, you start doing a SWP, systematic withdrawal plan. To give you an example, if you invest 1 lakh of rupees, if you're going to get 8%, then it's 8,000 rupees of estimated income for the year. Divide that by 12, and the answer that you get, you can start doing an SWP of that order. So now there is one more little tip here. If you are absolutely well versed and sure about what you want to do, then you can do this yourself. Otherwise, it might also be good help to take help of professionals who are involved in this field.
All right, that's a wrap on Investor's Guide. Karthik, thank you so much for answering our questions. Remember, anything you have to ask us about your money, whether it's about saving tax, spending, getting more organized, teaching your children how to use money, any of those things, we're right here to help you. We're particularly fond of mutual funds on this show. Send in any question you like. Thanks for watching.